Good morning, traders. Welcome to an Ichimoku Cloud Chart Market Review of Tesla. In view of the recent results, I'm going to just recap the price action from an Ichimoku Cloud Chart perspective. I've got the daily chart up here. And just to recap, a couple of months ago, there was a fantastic cloud chart rebound here, and that's the kind of the trade that I went for when it sold off heavily and got to these cloud chart support zone, this whole cluster there. Tesla then ran into trouble at the bottom end of the cloud. The top end of the cloud, yeah, that was the resistance level at that time. Then sold off after meeting resistance at the bottom end of the cloud, sold off again, back down to this support level, yeah, which coincides well with that one there, that cloud chart level there, as well as these highs from November. That was a breakout price there, so that was a significant support zone. There was another entry point in around these levels. So then Tesla grinded higher, got to the bottom in the cloud, then successfully broke through the cloud significantly, which is fantastic. There was two MACD buy signals here at the bottom as well in around these levels, so that was a third and fourth signal, trading signal. Snapped right through the cloud, then ran into a little bit of trouble with this top in the cloud chart resistance here, as well as this standard line there, as well as this old support level there, that old cloud chart resistance level held. Then Tesla pulled back a little bit. Then it found support at the top end of the cloud of the 719 level. Now that's a significant support zone. Currently below that, there's downside risk in this current scenario down to 685, as well as the bottom end of the cloud. Yeah, this level. Let's put a line in there. This level, yeah. That level 675, and then the bottom in the cloud, yeah. So, but I do think we should see more support coming back into Tesla in and around these this cluster of support there. But we need to stay above the top end of the cloud here to remain bullish. It's not a problem from a cloud chart perspective if Tesla sells off into the cloud, a rebound from the bottom end of the cloud. So the bottom end of the cloud is a major line in the sand in terms of being bullish or bearish. Bullish above the cloud, bearish below the cloud. So Tesla needs to maintain an upward momentum here and really trade back above the top end of the cloud here. So we really need to see that level being retaken. On the 4-hour chart, we can see downside support up to 685. That's a significant front cloud support level. 675, and then this top in the cloud here at 660. So there's downside risk to these levels on a 4-hour chart. But price action is above the cloud on the 4 hour, so that's bullish. And if we get this rebound in around the 700 and 685 zone, then the upside target is this top in the cloud here at 722, 725, and then 659, 759, 760 as the next resistance target, and then the long-term target for now 830, 835 is this resistance line there on the 4 hour. Back to the daily though. Yeah, 835, the top end of the cloud here would be the target for the current trades. So provided that we get a rebound from these cloud chart levels within the cloud. So Tesla's not out the wood yet, but certainly as long as it stays above the bottom in the cloud, the rally should be okay. But there is downside risk towards these bottom end cloud chart support levels. But these are fantastic swing trade opportunities to go long if you're not in it yet. Go long these levels. I'll be adding some more here, and then trading it up to the top end old cloud chart resistance of 835. Now the results came out, and it's kind of a mixed bag depending on what number you're taking, and if you're very bullish or very bearish on Tesla, you can really take different arguments from the results. Now if I look at the current risk profile, we have a let me just go to the price chart, news estimates. Where is that? Here we go. Ratios, profit and risk. So you can see Tesla at the moment is still a low returns business because the return on equity is barely, it's still below 10%, 6.9%. So although that is a good figure compared to zero interest rates, but still, 6.9 is not really a very good return on equity. But it's a young company still trying to prove that its cars are a good product, so to speak. So just be aware that it's been improving, but it's still a low returns business. Generally a good quality company generates a return in excess of 15%. So this is a low returns business. Okay, so far not a and that probably explains why Musk likes to take such large salaries in stock-based compensation, because it is the long-term sustainability of this type return business is brought into question. Now, in terms of risk profile, be aware that the downside, the 5-year average monthly beta is 3.43, so it's 3.43 times more volatile than the market. So work that into your risk profile and stop losses. And the downside beta, 5-year downside beta, is 1.6 to 1.7, and that means that if the market goes down 1%, your stock should go to 1.7 to 1.6, almost twice the amount of risk, downside risk in Tesla, for example. Okay, so let's go and catch up with some of the results quickly and see what the risk factors are there. So I'm going to bring across the results presentation. We can see the automotive revenues up 75% year over year, and regulatory credits up 46%. So that makes still a very big chunk of the company's profit comes from regulatory credits. So be aware of that, and hence that's why you can also see why Tesla keeps taking these, because the car company is just generating a low return on equity. It's a low returns business, despite the big fanfare on Twitter and everybody. It's a low returns business. Basically, look at the numbers, it's rather obvious. The other thing to look out for is the big disparities between GAAP and non-GAAP figures. There you can see there's huge disparities there, so lots of creative accounting going on. So you can see that it's a big risk factor that we look for. The big difference between GAAP and non-GAAP earnings tells you there's a lot of also on the cash flow, there's a lot of items in the cash flow that are non-cash based or considered non-cash based when they should actually be part of the expenses, etc. But just be aware that there's a huge difference between the GAAP and non-GAAP earnings. And if we go down, scroll down to the summary figures here, a couple of nice photographs, but yeah, let's go. Yeah, so we can see here the key metrics. Quarterly vehicle delivery units clocking out very well. So far so good. The operating cash flow, what they like to show and what we look at is free cash flow. That is that's down significantly, and operating cash flow is also down, but free cash flow is down significantly. But generally you can see the first quarter of every year is quite a down, in terms of negative free cash flow. So they did spend some on capex, but not as much as in the past. So that's one thing to look out for. Also, you can see the difference between the net income and the adjusted EBITDA. Also huge disparities there. Focus on the net income. The blue line is more important than the adjusted EBITDA. And there we can see, it's tracking up nicely, but it's not as profitable as the headline number you'd like to, as the company's marketing itself to be. Once again, net income and adjusted EBITDA, yeah, you can see there 12 months trailing. So 1, 2, 3, 4 quarters year over year of profitability on a net income basis, but adjusted EBITDA, once again, huge disparity in these figures, and therein lies the risk. So be aware of that when you trade these. You can see where all that, if we're going to look at the free cash flow, and there we can see where the story really starts to, the risk starts to unfold. You've got your net income there, and then stock-based compensation. That's Musk's stock-based compensation that comes in over there, 614. That's a huge figure. So looking at the reconciliation of the GAAP to non-GAAP financial information, you can see net income attributed to common stockholders, the GAAP figure is 438, and here's the stock-based compensation, 614. million. That's quite a lot. So you can see, Tesla's really the personal piggy bank of Musk in terms of getting compensation on a stock-based, expense basis. So be aware of that. That's also another risk factor in the stock, that there's a tremendous amount of money being siphoned off Tesla, even though the company is not that profitable. And it's a low return business, once again measured by the return on equity, as we highlighted before. So back to the valuation, EV to EBITDA 12-month trailing 138 times. So it's a frightfully expensive stock considering the nature of the low returns business, as well as the fact that it's the options expense of Tesla is a personal piggy bank of Tesla's a personal piggy bank of Musk. But anyhow, be aware of the risk. So once again, low returns business, lots of creative accounting going on. Can't survive without carbon credits, but it's still a popular stock, and as long as it keeps going up, what's not to like? Looking at the weekly, you can see the weekly front end in the cloud is a key support zone for the weekly, with downside risk to the bottom end of the cloud if there's significant weakness. But so far, Tesla is not out the woods yet, but certainly needs to regain price action above the 719 zone for us to be ultra bullish. Until next time, happy cloud chart trading.